I want to welcome everybody today to our first Get Savvy, Grow Your Green Stuff webinar of the 2021-2022 academic year. We're going to be talking about leveraging financial technology, or FinTech. If you aren't familiar with Zoom, hopefully everybody is at this point in 2021. However, if you're not, or you're not familiar with how we run our webinars here on the Get Savvy team, I just want to draw attention to the fact that we use the chat a lot. So if you aren't sure where the chat is, there's a black bar either at the top or bottom of your screen that should show kind of some options. And there's a little chat button, little icon, that I want you to open up and let us know if you can hear me. Hopefully you can hear me today. We've done a lot of mic testing, so hopefully everyone can hear my voice. If you are having trouble hearing my voice, let us know in the chat. We have people monitoring the chat to try to troubleshoot any audio issues that you might have, but we want to make sure that you know where the chat is because we're going to use it a lot today. We kind of run this, as my colleague Kathy likes to say, as a three-ring circus. So you'll have presenters talking about all the information that we share on the screen. We'll also be dropping links in the chat for more resources and information and tools. And we'll also have people monitoring the chat in case you have any questions. So if you do have any questions, don't bother holding them till the end. We have people monitoring them so we can either get them answered in real time at the end of the webinar, or if we don't have time to get you an answer today, right now, we will follow up via email or include in the follow-up email questions or frequently asked questions and answers. So don't hold anything back. Just be respectful when you're using the chat. Okay, like I said, we're going to be talking about leveraging financial technology. This is one of many Get Savvy, Grow Your Green Stuff webinars of this year. We have a whole team of people that are working on the content for the webinars. I'm just going to kind of share the team here. We made cryptocurrencies to represent them. So we're pretty excited about that since we're talking about financial technology today. My name is Andrea Pellegrini, and I run the Student Money Management Center for the entire University of Illinois system. And I'm joined today by my colleagues, Kathy Sweedler and Jake Hamilton. Jake, do you want to talk a little bit about yourself?
Yeah, thank you, Andrea. My name is Jake Hamilton. I work for the Division of Banking within the Illinois Department of Financial and Professional Regulation. I do a number of things for the Division of Banking, but I've come to kind of specialize in FinTech and cryptocurrency research for the department. So I'm really excited to talk to you guys about that today.
And we are so excited to have Jake with us. And Kathy also helped with the content for this webinar, and she's monitoring the chat. Kathy, do you want to talk about yourself a little bit real quick?
Sure. Just so excited to have everybody on today to kick off our Get Savvy webinar series this fall. I work with Illinois Extension. I'm a consumer economics educator and serve the East Central area of Illinois, as well as like today where I get to talk to people from all over. So I'll be chatting with you in the chat.
Thank you so much, Kathy. Since a lot of the organizations that represent the Get Savvy team are based in Illinois, we want to do kind of a land acknowledgement of the organizations that we represent. So we would like to begin today by recognizing and acknowledging that the organizers of the Get Savvy, Grow Your Green Stuff webinar series primarily reside in Illinois and serve the state of Illinois, which includes ancestral lands of the Peoria, Kaskaskia, Piankashaw, Wea, Miami, Mascoutin, Ottawa, Sauk, Meskwaki, Kickapoo, Potawatomi, Ojibwe, and Chickasaw nations. We have a responsibility to acknowledge these Native nations and to work with them as we move forward as a vibrant and inclusive society. So as we mentioned, since we are serving primarily, or we are based primarily in Illinois, we want to know either in what state or what county within Illinois you're logging in from today. So if you can put that in the chat, kind of where you're logging in from today, that gives us an idea of kind of the broad geographic region that we are reaching. Oh, someone's from New York City, a lot of Champaign County, Sangamon County, Vermilion, Minnesota, Florida, ooh, Lake
Upstate
County,
New York.
Yes, this is amazing. Colorado, Kane County. All right, keep them coming. Let us know. We're going to continue moving forward. So I'm going to hand it over to Jake to talk about our learning objectives.
Thank you, Andrea. Yeah, real quick, we just want to talk about what our learning objectives are today. The first is that we want to define financial technology and the related terminology surrounding it. We also want to review some well-known financial technologies and their uses. We want to discuss what blockchain and cryptocurrency is kind of as a separate topic. I mean, it's a part of financial technology, but we want to go over that a little bit more in depth because we know that's a complicated topic. We want to explore the impacts on financial services and the environment. And we want to understand the security risks and benefits of FinTech. All right, so let's hop into some of our definitions of FinTech. FinTech, via the Oxford Languages, is defined as computer programs and other technology used to support or enable banking and financial services. It's more broadly called financial technology, but you're going to hear me and Andrea as well refer to it as FinTech today. It's just a little bit shorter, but FinTech is short for financial technology, and it's used to refer to technology that is supporting or enabling banking and financial services. Some prominent examples of FinTech that we're going to go over today are digital and mobile banking, peer-to-peer payments, digital wallets, blockchains, digital currencies and cryptocurrencies, investing apps and Robo Advisors, budgeting and shopping apps, as well as a few more. There's numerous examples of financial technology, but these are just some of the more prominent ones that people may have heard of before. So if you want to go ahead and post in the chat for us, just post what kind of FinTech are you guys familiar with or most familiar with. Maybe it's mobile banking, maybe you have an app on your phone that you do your banking services at, maybe it's a peer-to-peer app where you send money to your friends and family, maybe it's cryptocurrency. So go ahead and post in chat what kinds of FinTechs that you are most familiar with. I see some mobile banking, couple mobile bankings. I also use a lot of mobile banking. PayPal, that would be a peer-to-peer app. Yep, PayPal for sending money. That is an oldie but a goodie. Financial aggregators, Cash App, Zelle. Yep, we're going to talk about those today. All right, Venmo, Betterment, online banking. Great. Okay, so it looks like everybody here kind of uses a number of financial technology, lots of different examples of financial technology. So that's good to hear. We want to talk a little bit briefly about the impact of financial technology. So FinTech is one of the largest and fastest growing industries and sectors in both the United States and the world. So just to briefly talk about these points on the screen here, a Goldman Sachs study in 2015 estimated that FinTech would disrupt 4.7 billion in revenue that traditional financial institutions now make. Well, that was now, as in 2015 now. But what disrupt means is that it could kind of disrupt some of the traditional business models of financial institutions like banks and credit unions and how they typically earn their money through, your checking accounts and savings accounts. So FinTech could disrupt 4.7 billion in revenue from traditional financial institutions. We also look at a 2015 study by KPMG that saw US FinTech companies seeing $18.3 billion in investment in 1 year. And in August of 2019, 89% of survey respondents reported that mobile banking use reported using mobile banking use. So almost 90% of survey respondents reported using mobile banking, according to Business Insider Intelligence Mobile Banking Competitive Edge Study. And then the last thing, looking kind of towards the future, there was another study in 2020 that globally FinTech has a CAGR, that stands for compound annual growth rate. So the amount that it's going to grow annually as a sector of around 20% for 2020 to 2025. The total financial sector, so all traditional modes of finance like banks and credit union and stocks and bonds and investing, the total financial sector compound annual growth rate is 6%. So if you could kind of compare that 20% to 6%, FinTech is growing very quickly, especially compared to the traditional financial sector. So let's dive in a little bit to some older types of FinTech, as well as some new types of FinTech. So the first one, and a lot of you already responded in the chat that you're familiar with digital and mobile banking, but digital and mobile banking are probably the most well-known and widely used examples of financial technology of FinTech. It's a very popular option for that most banks and credit unions offer some form of digital or mobile banking. It's very rare that you see a bank or a credit union that does not offer a way to access a customer's accounts online or through their app. Even at small banks, most are offering digital and mobile banking these days. But this has kind of changed the landscape of how consumers interact with their financial institutions. Mobile banking brings convenience as well as accessibility. Users can log in almost anywhere, anytime, as long as you have a connection to the internet. Now, you might be up in the mountains hiking, and I don't know why you would want to check your banking account at that time if you're on a nice hike in the mountains with no signal, but you might not be able to there. So maybe not anywhere in the world, but from most places, as long as you can connect to the internet, you can check on your bank accounts, and it expands services as well. So digital and mobile banking offer many services that you no longer have to go to a bank just to do them. Just a few include looking at your accounts and balances, checking your balances, reviewing your account history, paying your bills, including setting up automatic payments or maybe automatic savings. And you can even deposit checks a lot of ways via a mobile deposit on like an application on your phone. I know this is a common way that I deposit my own checks when I get them. I just snap a pic with my phone of both the front and back of the check, and then the app can deposit right there. I don't have to take it to a physical banking or credit union location. And even we've seen FinTech use, especially mobile banking and digital banking, jump even in the last year due to the COVID-19 pandemic. So according to Fidelity National Information Services study, in April 2019, there was a 200% jump in new mobile banking registrations. So that was right after the pandemic started in March. A lot of what we call them is brick and mortar physical branch locations, like your banking branch or your credit union branch. They closed their lobbies down due to the pandemic so that people weren't spreading the virus. And so people now who maybe were used to going into the bank to do their banking needs now had to find other ways to do that. And a lot of them did it through digital and mobile banking. So in April 2020, like I said, we saw that 200% jump in new mobile banking registrations. And there was also an 85% jump in mobile banking traffic, according to this study. So if we're going to go back to the chat again, if you guys could just maybe talk to us about how do you guys prefer to access your financial accounts? What is your preferred way? Do you still go to the bank, or maybe you go through like a drive-through ATM, or do you like to access them digitally? Do you do it on a computer at home, at the library? Do you do it on your phone, on an app? Okay, I'm seeing some responses. Mobile banking. Saw one, computer, web. Does anybody still go to their physical branch? Online and sometimes bank, in person. Okay. ATM, I see that. All right. Some great responses. Well, I think I'm gonna toss it back to Andrea now, and she's gonna go over some popular peer-to-peer payment systems, or P2P, but I'll let her explain that.
Thank you so much, Jake. So I know some of you have already mentioned peer-to-peer. It's often sometimes called P2P as well. It's kind of, as you mentioned in the chat, some of the more popular apps or companies that provide peer-to-peer service is things like Venmo, Cash App, PayPal, Apple Pay, Google Pay, Zelle. Those are just some examples. There are many, many different peer-to-peer services that you can check out with your mobile app or any other device that you want to use. So we want to kind of talk a little bit about how P2P or peer-to-peer works. So you obviously download an app or you activate the service. Some P2P services may be included with your online banking services. So checking what you already have access to can be really helpful for minimizing where all your financial information goes. And it often works also as a social media. So you might see a feed along with your P2P transfers. When you pay a friend, you can kind of see anyone that you've made transactions with, or you're on your friend list, kind of what their activity is, if you allow it. You also can connect your bank account or credit card information to that app. If you are using a credit card to make transactions through a peer-to-peer service, it may have additional fees, which is why it's really important to read that fine print and kind of know what your service is, how it makes money as well, and what the risks are for yourself. And then you can send and receive money through that app to friends, family, or businesses. Those transfers can take 1 to 3 business days. There might be features that allow you to speed up that process if you pay an additional fee. And you can even pay across international borders sometimes, and that currency exchange is included in that. But again, read that fine print. We're going to put some sources in the chat. It looks like Kathy already did. Thank you, Kathy, to give you some more information about what to look for when choosing a P2P app. One really important thing to consider is that not all peer-to-peer services are insured like the traditional financial institutions. If you've been listening to our webinars for any amount of time, you probably know every time we talk about bank or credit union, we usually talk about looking for an FDIC insured bank or an NCUA insured credit union as you're choosing bank accounts, because you're insured up to $250,000 per person on a savings or checking account at those insured institutions. Zelle is one of those types of services that are provided through a financial institution, and it's insured through that institution as a peer-to-peer service. However, things like Venmo and Cash App are not insured. So if you're holding a lot of money in those apps, your money is at risk if it gets hacked or you lose your password and can't access it anymore. So a couple ways to reduce your risks is by knowing whether or not that peer-to-peer app is insured, and then transferring any money that you do receive to an insured account if it is not. So again, read that fine print, know what the services are and the features are, and be willing to make changes if something changes and you don't like what their new policy is. All right, so just a note, because we know that so many people are relying on small businesses right now, side businesses, and using peer-to-peer like Venmo or Cash App or PayPal to manage their business transactions. Just be mindful that there could be legal issues and tax liability depending on how you accept payments. For instance, PayPal just implemented the goods and services versus family and friends payments. The goods and services has an additional fee for vendors, but it protects the consumer paying for that service. So there's a lot of things to consider. Read the fine print, consult your attorney or your financial planning person if you have a business and you want to know what's the best long-term process for expanding your business. So again, you might want to consider different payment processing solutions in the future to reduce costs and increase your security as a business. And if you are using PayPal or Venmo or any type of P2P as a business transaction service, having no insurance means that you need to transfer that money or your business capital regularly to protect your business finances. So just want to keep those things in mind if you are using P2P as a side business or small business. All right, so do you use any peer-to-peer apps? I think that a lot of you do, but just thinking about why you use peer-to-peer apps or how it's convenient is really helpful. So someone uses PayPal. I use PayPal almost exclusively because it came out when I was much younger until recently, and I expanded my peer-to-peer options. Zelle, Venmo, Zelle, PayPal, lots. There's a wide variety. Cash App. That also means that if you're paying one person that only has one option, you might have to expand what you're using to pay your friends, right? All right, there's so many options. Okay, let's keep going. We got a lot to cover. So the other thing we want to talk about a little bit is digital and mobile wallets. So digital and mobile wallets allow you to store payments online, like on a vendor's website or on your phone to make purchases quickly. So digital wallets is more of a broad umbrella term that includes mobile wallets. You might be familiar with Apple Pay or Google Pay or Samsung Pay that are kind of associated with specific types of mobile devices. But there are also digital wallets that exist within apps or on websites if you store your financial information to make payments. Like Starbucks has an app where you can load your credit card on it and then transfer money to it. So you have kind of a digital wallet within the Starbucks app. Same thing with Amazon. You can store your payment options, like different credit cards that you use or gift cards that you use on Amazon in order to make transactions a little bit faster. So just a brief overview of that since we have a lot going on. When you are thinking about digital wallet security, you want to know the different types of encryption provide different levels of security. There's lots of encryption out there and it can be very daunting to understand what's the best option for you, but knowing that there is encryption, knowing a little bit about whatever is being provided is important. You also want to consider what authentication methods that they have available. Multi-factor or two-factor authentication is really helpful for protecting all of your money, especially if you store multiple cards in a digital wallet. You also want to think about passwords and PINs. Passphrases with a variety of characters is going to be a lot better than just your childhood dog's name and your birthday. So obviously you want to think about that. We'll be talking a little bit more about passwords and PINs and methods of management later as well. You might also consider biometrics security. So that's things like Face ID or fingerprint scanning to secure your devices as well. And then you also want to avoid storing payment information on sites that you don't use very frequently, just to protect your money. All right, so let's talk a little bit about saving and investing apps. These have become more popular in recent years as a way for more people to access the stock market and investing, and kind of as a way for users to invest whatever amount of money that they're comfortable with. So for example, there's Robinhood, you might have heard of, E-Trade, TD Ameritrade, SoFi, Acorns. There's just so many apps out there to help you with saving and investing. You might also think about Robo Advisors being included in those, but mainly saving and investing apps provide a place to save money, sometimes advice on investing, and an option for buying and selling securities where you don't have to go through a specific person or call someone in order to make a transaction. All right, so I briefly talked about Robo Advisors. I mentioned it. We just want to define it so that you guys know as we talk about this a little bit further, is that it's an online application that provides automated financial guidance and services. They're also a type of investment advisor that typically registers with the SEC, so the Securities and Exchange Commission, but they're not real people. They are robots. They're Robo Advisors, but they make their suggestions based on data. So just something to keep in mind. So we like to use that chat. What do you think are the pros and cons of investing online or with apps on your phone? If you can put that in the chat, what you think are the pros and cons of investing online or with apps. This is kind of a complicated question to think about, especially since we're moving so fast. All right. There's possible security and privacy compromises. That's true. All right. Because we are a little behind on time, I'm just going to skip ahead and tell you what some of the pros and cons are. So some of the pros are it increases access for people that have traditionally been unable to access these markets. It often provides no account minimums, right? So you can start with very, very little money. They're often easy to use. The robo advising option helps to get you information in real time based on data. You can automate your investing, which is helpful, and you can kind of set it and forget it. I'm a big fan of set it and forget it personally. It's my favorite method of financial planning is automating what I can. Some of the cons are that on average, the day trading option underperforms long-term passive investment strategies. So the more you mess with it, the more likely you are to lose money. Some of the risks can also be difficult to understand depending on how the user interfaces are created and designed. Sometimes there's also customer service issues, like if there's a big blackout and you're trying to get access to a real person to see why you can't access your account, that can be a problem. Obviously, platform outages can be a problem as well. And then sometimes there's a lack of transparency about costs and fees, which can happen if you call a real person. But sometimes there's, with the way user interfaces are created or designed, sometimes it can be easy to think that things are transparent and they're not necessarily. So again, that fine print is so important to at least skim if you don't read it completely. So some other features of saving apps and some of the financial technology that we have available to us are automatic transfers and Roundup savings. So automatic transfers, as you might expect, allow you to set up regular periodic transfers of funds from a designated account to another designated account. I automate a lot of my savings behavior because, again, I like to set it and forget it. Roundup saving is another method of saving where you associate a specific card with the saving app or the Roundup saving service that's provided. And when you spend money with that associated card, money is automatically rounded up to the nearest dollar or half dollar, depending on how you have it set up, and then transferred for savings or investing into another account. So that's a really beneficial way to do small savings, because we know that small amounts add up over time, especially if you're making a lot of smaller transactions. You just need to be mindful of, if your budget's tight one month, you want to monitor what's going on with your Roundup savings as well. All right, so if you want to learn more about investing, we did an Investing Basics webinar in the spring, which you can watch on YouTube as soon as you're done listening to us talk today. Or you can also sign up for the Steps to Investing webinar that we have planned for January 2022, which is the same go.uillinois.edu/getsavvywebinars URL that you use to sign up for this webinar. All right, so I'm going to hand it back over to Jake to talk about cryptocurrencies, which is really why you're all here today.
Thank you, Andrea. Yes, I know cryptocurrencies have definitely been in the news a lot over the last year, but thank you, Andrea, for giving us all that great information on these other examples of financial technology. I know that I myself like to use, the automatic savings and all these different kinds of financial apps. So thank you for breaking that down. But let's get into cryptocurrencies a little bit and blockchains as well, and we'll define those terms a little bit later. But let's talk about what a cryptocurrency is. So a cryptocurrency is a completely digital currency that is representing some kind of value online digitally. So that might be a little confusing. You might say, there's a lot of money that is digital in nature today. When you swipe your debit card to make a purchase at the grocery store, that money is digital. You're not giving physical cash to that person. But a cryptocurrency is a representation of value online that is more similar to cash than it is to a debit card purchase. It's kind of a form of digital cash, to be specific. And what they do is they use cryptography, which is kind of a computer science term, to maintain verified records of transactions through a decentralized system. And there's thousands of different cryptocurrencies that exist. We're going to go over some of the more popular ones, but there's literally thousands. It all exists online. It's all on the internet. So anybody really at any time, if you have the information and you have the knowledge of how to create a blockchain and a cryptocurrency, you can do it. So that's why there's so many of them out there. But we'll talk about some of the popular ones today too. And speaking of that, what cryptocurrencies or maybe blockchains have you in the audience heard about? I expect to see probably some familiar ones. Bitcoin obviously is a popular one. Bitcoin, Dogecoin, yes, Dogecoin has been in the news a lot over the last year. There any others out there maybe? We can talk about, let's move, Ethereum, yes. Okay, well, let's move on to the next slide, and I'll just tell you about the top 10, at least by market capitalization. So market capitalization is, value times quantity. So these are the largest markets of cryptocurrencies. Bitcoin is the number one by a large amount. Bitcoin is very popular. It's been around since 2008. I don't think a lot of people knew about it back then. It was kind of just this like fancy new technology that kind of, people who were in that space might have been excited about, but Bitcoin has grown to be a huge commodity. And its current market capitalization, we updated this yesterday, as of yesterday, was 848 billion. The second largest is Ethereum, or Ether, which is the coin. And that is about 362 billion. There's Binance Coin, US dollar Tether, Cardano, XRP. The company that runs the XRP blockchain is called Ripple. You might have heard it by that name as well. There's Dogecoin, there's Hex, US dollar coin, and Polkadot. So these all do a little bit different things. Like Bitcoin, for example, is primarily used for sending value digitally, sending a value, an amount of money from point A to point B. That's what Bitcoin does. Ethereum is not really that. Ethereum's a little different. It's a blockchain-based platform that you can build apps on. So all these things do a little bit different things. Binance Coin, for example, is a decentralized finance, like an exchange where people can trade different types of cryptocurrencies. And Tether is what's called a stable coin. Tether is a stable coin, so it ties its value to the US dollar. So one Tether is always equal to one US dollar. And that, has some value in the cryptocurrency space because it holds value, whereas something like Bitcoin or Ethereum might not hold the same value. The value of Bitcoin, changes every hour, whereas US dollar Tether stays consistent. I'm not going to go into specifics because, I don't want to run out of time today, but I would just encourage you, if there's some you don't know about, just maybe do a little bit of research and look into them. So let's talk about how these actually work. So cryptocurrencies are basically the value what cryptocurrencies do is they represent value on a blockchain. And blockchains are a form of decentralized ledger technology. And blockchains are the basis for any cryptocurrency. So blockchains use a decentralized network of nodes. So when I say decentralized, think like not in one place. So it might be computers scattered all over the US, for example. There could be a computer in New York, there could be one in Chicago, there could be one in LA, and those would all be nodes in the larger network. And what they do is they confirm transactions across the network and then add them to that transaction to the ledger. Primarily what these are, blockchain is a fancy word for a ledger. They just keep track of things going back and forth. Like that's, your bank has a ledger for all the transactions that you make, but they do that in a centralized way. Your bank is the essential authority. They keep track of all of that themselves. What blockchains do is they do it in a decentralized way through a network of nodes, or think of nodes as computers. And so they're just really just a ledger keeping technology. And like I said, for fiat or government-backed currency, so like US dollar, our financial institutions serve this role. Our banks are normally the ones that keep track of all our transactions, but on a blockchain, the blockchain itself, the technology is what automatically keeps track of the transactions. That's how it works. So in other words, maybe a simpler way to explain it is that banks keep record of our transactions for traditional currencies, where everybody who participates in a network keeps the record simultaneously for cryptocurrencies. And just to define blockchain, to give like an official definition, it's a chronological database of transactions in which a copy of the ledger is stored on every computer in the network, and these computers periodically synchronize to make sure that all of them have the same record of transactions. You don't want one computer in the network to have a different record of transactions the other one, because then it will fall out of whack. They have to have the same record of transactions. Blockchains and cryptocurrencies, while you often hear these terms associated together, they are not the same thing. And I know that can be a little confusing because so many times, you might hear about Bitcoin is a cryptocurrency, but the Bitcoin blockchain is also, people talk about Bitcoin, the blockchain, and they also talk about Bitcoin, the cryptocurrency, but they're not the same thing. Blockchains are the ledgers where the transaction data is stored. Cryptocurrencies are the tokens or the digital representation of value that is used to conduct the transactions. So a better example of this might be the number 2 cryptocurrency by market capitalization, Ethereum. Ethereum is a blockchain platform. So the Ethereum blockchain, actually the coin that the Ethereum blockchain uses to send value back and forth is called Ether. So if you were to go to like Coinbase, which we're going to talk about exchanges in a couple other slides, but if you were to go try to buy Ethereum, the actual token that you would purchase is called Ether. So Ether is the cryptocurrency, Ethereum is the blockchain. When you talk about Bitcoin, there's really no differentiation. So that's why I like to use Ethereum as kind of a better example that blockchain and cryptocurrencies are not necessarily the same thing, even though they're very interrelated. And the invention of blockchains allowed digital currencies to kind of exist because they fixed the issue of double spending. Blockchains automatically keep these ledgers for us so that we know someone hasn't already spent the money elsewhere. Like if I want to send money to you online, a blockchain can automatically tell me that you haven't spent it somewhere else, because I can look at that record of transactions, or my computer can look at that record of transactions and say, okay, this money is there. They can verify that the money that you want to send to me online is there. That's what the blockchains do for us.
Jake, we have a really good question in the chat that I think we'll touch on later, but I think it's valuable to kind of address now. What are the cryptocurrencies based upon? For example, dollar is based on gold.
Yeah, so I just saw that question. Thank you, Andrea. So that's a great question. The US dollar used to be based on gold. Like the dollar used to be backed by gold. It no longer is, since there was this big meeting of basically bankers and government officials back in like the 1960s and 70s called the Bretton Woods Agreement, where they basically, the US agreed to go off of what they called the gold standard. So the US dollar stopped being backed by gold reserves back in the 1960s or 70s. I don't have the exact year off the top of my head, but it's called the Bretton Woods Agreement if you want to look more into that. Cryptocurrencies, their value, and we're kind of going to talk about this in the way that people use them. Their value is based on kind of the speculative value of what people trust in the chain. So Bitcoin, for example, is not based on a real world commodity. The value of Bitcoin changes rapidly, but what it's based on is basically what somebody's willing to buy a Bitcoin for. So it's kind of like a stock or a bond. If I want to sell stock in a company, I'm only going to get what somebody is willing to pay for that stock. Bitcoin operates in the same way right now. So if I want to sell my Bitcoin, I'm only going to get what somebody is willing to pay for it. So yes, supply and demand is kind of where they derive their value, but there's no commodity that's backing a cryptocurrency. Jason, that's a great question. Are any governments getting into cryptocurrency game or backing cryptocurrencies? So yes, actually, there are governments that are considering this. The Chinese government has actually created what's called a central bank digital currency. So our governments have central banking authorities. In the US, you may have heard of it, that the US, our central banking authority is called the Federal Reserve. In Europe, which operates on the euro, they have the European Central Bank. China has the Chinese Central Bank. The Federal Reserve is considering creating a central bank digital currency that would be like basically a digital dollar. The Chinese Central Bank has created a central bank digital currency. So they have a digital renminbi, which is the native currency in China. The fiat currency in China is the renminbi. And they have gone ahead and created that. The US dollar is considering it, but they haven't made any decisions yet. The European Central Bank is also considering doing a central bank digital currency, but they have not moved forward yet. So China is the first one to do that. Let's go ahead and keep it moving so we don't run out of time, but hopefully we will be able to get to some of these questions at the end as well.
Absolutely. We'll get back to these questions as best we can near the end. We want to keep going with what we have planned for content.
Okay, one of the other things that we want to talk about when it comes to cryptocurrencies is our consensus mechanisms. And you may have heard of the term mining, blockchain mining. What that refers to is the consensus mechanism. So we've talked about how these networks of nodes confirm transactions together. And the way they do that is if you have 100 different ledgers on 100 different computers, those computers have to build consensus. They have to all agree to one version of the ledger. And the way they do that is through what's called a consensus mechanism. And there are actually a whole lot of different types of consensus mechanisms, but we're going to talk specifically about two of the most notable and popular ones, proof of work and proof of stake. So proof of work is probably the most popular one and most well-known. The Bitcoin blockchain operates on proof of work. This was the Bitcoin white paper in 2008, who was created by an anonymous poster, Satoshi Nakamoto, basically created this system of proof of work. And that's how he created the Bitcoin blockchain. He created this consensus mechanism, or she did, or a group of people. We don't know who Satoshi Nakamoto actually is. But what it does is that when they want to confirm a transaction, a node in the network has to solve a complex math problem. Think of like, they basically have to solve like a very complex math problem that's relating to like a random sequence of numbers, and they have to figure out the sequence. but they have to confirm that, they have to solve that complex math problem to confirm transactions and add to the blockchain. And when a node does solve that problem, they're rewarded for solving the puzzle in the blockchain's native token. In the case of Bitcoin, they're rewarded with Bitcoin. And so once they solve that puzzle, they add a block to the chain. All of the other computers in the network look at that block. They confirm that the data matches up with their data that they have on the ledger already on the network. And then they agree to add that node, and then it gets added. And then once it's added, the node that confirmed that problem put in the work, the proof of work, they get rewarded. So you may have heard, especially lately, that proof of work has been criticized for being energy intensive and having a large carbon footprint. The Bitcoin blockchain's energy consumption is on the level of like some small to mid-sized countries or nations. I think the last time I checked, it had like the Bitcoin blockchain was consuming like the same amount of energy as like Switzerland or Chile. So it does use a lot of energy. And when it's fueled with non-renewable energy, the Bitcoin blockchain or other proof of work blockchains that are large can have a large carbon footprint. You saw like Tesla said that they were not going to accept Bitcoin as a payment anymore because of its environmental footprint. That was big news. It kind of hit the value of Bitcoin quite a bit. So that's proof of work. It's a notable one. And it's been criticized for being energy intensive, although there are people who are working on it to make sure that Bitcoin, for example, uses clean energy or is using different forms of energy that are not as dirty as some fossil fuel based forms of energy. The other one we want to talk about is proof of stake. This is becoming more popular. Ethereum, the number 2 blockchain, Ethereum is in the process of switching to a proof of stake consensus mechanism. So the way this one works is that if you are a part of the network and you own, let's say, Ether, for example, you can stake a certain amount of the value of your token. So let's say if I have 100 Ether, I can choose to stake 80 of them to help confirm transactions. And what happens is that the more stake you put in, the higher chance you have of being randomly selected as the node to add to the blockchain. And the idea behind this one is that the more stake that you have in the success of the blockchain, the less likely you are to add fraudulent data to the blockchain, which would obviously disrupt the blockchain. So the idea behind it is that the more stake, the more you have to risk in losing in the blockchain, the more likely you are to confirm good transactions. And that's how this one works. And so the more that you stake, the greater chance you have of getting rewarded, because your percentage chance of being rewarded is based on how much you stake compared to the rest of the pool of stakers. And since this doesn't require the computer to do all that computing work and solve a complex, mathematical problem, it's a lot less energy intensive. It's all randomly generated and it works itself. So it doesn't have that kind of computing behind it that requires all this energy. And so it's kind of been propped up as a competitor to this proof of work and an alternative that is much less energy intensive. Bitcoin has not announced any changes to its consensus mechanism, but Ethereum, which is currently running on proof of work, is in the process of switching to proof of stake because of this. So let's get down into how you can actually use your crypto. We talked about how they work and what they are, but you guys probably came here because you want to know, how can I use it? What can I do with cryptocurrency? So right now, the most common way that people are using cryptocurrency is as an investment. Most cryptocurrency users hold their crypto or trade it like a security. Think like a stock in a company or a government bond. You can trade it on an exchange. Like I talked about earlier, the value of like Bitcoin is based on what someone is willing to pay for it. So they treat it like an asset or an investment. You might have a portfolio of cryptocurrencies. You might own some Bitcoin, you might own some Ether, and you might own some other different cryptocurrencies. And right now people are betting on the value of those cryptocurrencies going up, and they're treating it as like an asset class, as an investment. Cryptocurrencies can also be used, like their name suggests, as a currency, as long as a seller is willing to accept it as a mode of payment. There's no reason that you can't use a cryptocurrency to buy something. And like I talked about earlier, Bitcoin does one thing really well. Bitcoin transfers value from point A to point B online very well. There's examples of like people who have purchased a house with Bitcoin. Like I said, Tesla formerly was accepting Bitcoin as a form of payment. They're not anymore. You heard stories about, people when Bitcoin first kind of came onto the scene and like people knew about it. There's this one story about a guy who spent like 1,000 Bitcoin to buy like a pizza back in 2009 or something. Obviously, he didn't know at the time that Bitcoin would one day be worth a whole lot of money. So he spent on pizza at the time. But you've heard stories like that, or maybe you have heard of stories like that. But cryptocurrency, as its name suggests, can be used to buy and purchase goods. There's also other applications that Bitcoins, or not Bitcoins, but cryptocurrencies are used for. One is settling trades, like actual trades for like stocks and bonds. Right, currently, it takes about 3 days to settle a trade in the US. It takes about 2 days in Europe to settle a trade. But a blockchain theoretically could do that instantaneously or within minutes to settle a trade, because it's all automated and it doesn't require a central authority to confirm all this information independently. The blockchain does that automatically. So theoretically, they'd be really good for settling trades. Cheaper and faster remittances. So remittance is just a fancy word for sending money somewhere. Like I said, some blockchains are really good at sending value from point A to point B, especially over international boundaries. So there's a lot of regulations that you have to go through if you want to send money from one country to another. But on a cryptocurrency, you theoretically would be able to do that much faster and much cheaper. They also can be used for expanding financial access. Oh, sorry, can you go back, Andrea? Yep, one more time. They can be used for expanding financial access. People who might not have access to a bank in their area. There's these things called banking deserts. Theoretically, if they have internet, they could have access to a cryptocurrency instead. They also are used for smart contracts, which is kind of like an automated contract to transfer value back and forth. Once certain agreements are met to, then the smart contract can automatically transfer funds. So there's a lot of ideas for people using that. And then even outside of the financial sector, blockchains are known for being really good at keeping track of things. So people are applying them to like supply chain management, or keeping track of, like, for government purposes, keeping track of like land titles or auto titles, or even keeping track of like digital IDs. So these are all things that cryptocurrencies and blockchains are theoretically being applied to, and the uses are constantly evolving. It's the technology is really only about a decade old, so people are constantly coming up with new ideas and new ways to use them. So where can you go to get cryptocurrency? You can get crypto through an exchange online. Like some of the popular ones in the US are Coinbase, there's Kraken, there's Binance US, or they actually have physical locations. There are crypto ATMs that exist all throughout the US and the world, where you can go to an ATM location and you can exchange your actual cash. You can exchange your $20 or your $100 for Bitcoin or Ethereum. So you can get that way, and then they would send you your cryptocurrency online. So once you have cryptocurrency, you buy it by exchanging your US dollars or whatever currency. I think everybody here is in the US today. So I assume that you would be buying it with US dollars, and then you exchange it for that. And then once you have it, you hold it in a digital wallet. Once you have it, you hold it in a digital wallet, like a central authority. So like if you buy cryptocurrency on Coinbase, you're going to hold it on a Coinbase wallet. And then there's also do-it-yourself wallets that you could transfer it to if you have the know-how to do all that. Then I know we're running a little short on time here. I know I'm running a little behind. So let's keep going through the slides so we make sure we can get to people's questions at the end. And then lastly, we want to talk a little bit about the risk here of cryptocurrencies. So like we talked about earlier, cryptocurrencies are not backed by any government. So for example, there's no FDIC insurance with cryptocurrencies. There are some regulations for cryptocurrencies, but they're limited. Like New York has a law called the BIT license for cryptocurrency companies. Wyoming has a special purpose depository institution charter. You can look more into those. We'll post links as well. Bitcoins do have, or cryptocurrencies do have high volatility. So we've talked about how the value can change rapidly. Sometimes, Bitcoin, for example, can drop thousands of dollars in a day. Just be aware of that. And then security wise, there have been hacks of like central authorities or exchanges that hold on to a lot of money. A notable one was Mt. Gox in 2014 that lost billions of dollars in Bitcoin to a hack. And then even if you're keeping it yourself on like a secured wallet, your own wallet, you could lose your password to that wallet. And then if you don't remember your password, your value in that cryptocurrency could be lost forever. There's no, on a do-it-yourself wallet, there's no I forgot my password button. And I know there's a lot of questions, and I know we're probably not going to be able to get to everything today because we're a little short on time, but Andrea and I, as well as our colleague Nikki Giancola-Shanks, are actually releasing a podcast today at 3:30 specifically on cryptocurrency, and we have a professor from DePaul University who's an expert in money and cryptocurrencies on to break all of this down in more detail. They just posted the link in chat, so it looks like that recording is already out. But you guys can check that out as well. And I'm going to pass it back to Andrea for the last bit here, and then we'll get some questions.
All right. I know that people probably need to go places and do things. This is being recorded, but I will try to get through this next section as quickly as possible so we can answer some of those really good questions in chat. So let's talk about leveraging financial technology to manage your finances. That's kind of the whole premise of this webinar today. So financial technology provides an opportunity for you and your money to be more connected, which means things are a lot more convenient. I don't have to physically go to the bank to deposit my checks, for instance, but it also produces some new and unique risks compared to only relying on a brick and mortar location to do all of your financial transactions. It also can be a lot more transparent than it used to be in a lot of ways. So that's one really good benefit to financial technology. But sometimes with transparency or perceived transparency, things can be overwhelming, or there's so much information that it can be murky, or it depending on how things are designed, it might be challenging to see the transparency in some of those transactions. And then automation provides a really good means of streamlining your financial tasks and even relieving some stress for monitoring accounts that will send you alerts if there's some weird activity. On several occasions, my credit card company has sent me push alerts on my phone, thanks to my app being on my phone, to let me know, hey, a transaction was just made in Texas at a Taco Bell. I've never been to a Taco Bell in Texas, so of course that was a fraudulent activity, and I was able to immediately contact my credit card company and stop any further fraud from happening. But that's because I set up automated alerts to come through on my phone. So because we're talking about all these different aspects of financial technology, both new and old, what do you think some of the risks are to using financial technology? I mentioned a few of them. We've talked about them throughout the webinar a little bit. You can put in the chat, like, what comes to mind when you think about the risks of financial technology. That would be great. Triggers to overspend, absolutely. Along with like access to a more connected financial world, right? Digital wallets are on your phone. You can more easily spend on those really fun ads on Instagram, right? Because it's a lot easier to just click a couple buttons instead of, where's my wallet? I got to put in the 18 numbers on my credit card. Exposure to hacks. That's also a really good risk with FinTech to acknowledge. One thing, those hacks always happened. We just didn't know about them. Luckily, companies are getting more and more transparent about when those hacks happen so that people can take steps to reduce their risks. All right, so keep them coming as you think about risks. I'm gonna highlight some of the big ones, right? You've probably realized by now that, like, with all of this financial technology, there are lots of risks, and some are a little bit more obvious than others. For example, data breaches and hacks, which we talked about, can expose our personal information, and we have kind of limited or either no control over preventing those hacks from happening. But like I said, those hacks have always been happening. They've been happening for years, but companies and organizations are being a lot more transparent about it now so that individuals can take steps to limit the damages where we can. Social engineering scams like phishing are a lot more sophisticated now. With our interconnectedness, scammers can actually scrape personal data from your social media sites and target your friends and family while posing as you to get their information. So this is why it's really important to limit what you share on social media and what third-party apps have access to things like your Facebook profile, for instance. Those complicated user interfaces that I keep mentioning for things like investing apps can cause a lot of confusion and stress if you don't understand what's going on. So there's a push by some in the software development industry to focus more on ethics in designing of apps and software to help protect individuals and limit the time suck that sometimes happens, especially with social media apps. But it's also important to think about it when you think about investing apps as well. So if you tend to over automate things, I talked about how much I love automation. It's easy to over automate things sometimes. So if you do that, it can kind of hinder customer service occasionally. So if you've ever, for instance, called your financial institution because you were locked out of your account and gotten stuck in a phone tree loop, who's been there? Who knows what I'm talking about? However, you can also over automate tasks like paying your bills. If you're not paying attention to dates and your account balances, you could easily overdraw your account or miss a payment. So it's important not to over automate, or at least make sure that you are monitoring what's going on with your finances to make sure that's not an issue when it comes to automation. All right, so I'm just going to rattle off some things that can help you manage your money and limit risks thanks to some of the advancements in technology, either financial or otherwise. Credit cards, I think, as we've mentioned a couple times in the chat, have more legal protections than debit cards. So if you are trying to minimize risk when setting up your first digital wallet or a new digital wallet, consider adding a credit card instead of a debit card if you're able. Setting up automated alerts like push notifications from apps or texts from your financial institution for things like large withdrawals, low balances, or other things you want to know about in real time can really help you manage financial stress and save time monitoring accounts for potential fraudulent activity. So you can also set limits on your financial activities to help you manage your own spending. So people can do this with their debit cards, for instance, on a lot of cases. You can use multi-factor or two-factor authentication to give you another layer of protection beyond that password or PIN security that is very helpful if you're trying to secure financial accounts. And it's even required in a lot of cases. So if you're in an area where maybe you don't get great cell service, you also might look for an option that allows you to use a hardware token instead of that multi-factor or two-factor authentication. We'll talk more about that in our next webinar, Identity Theft and Fraud, if you haven't signed up for it. If you've never heard of a virtual private network or a VPN, those can be helpful for securing your information when making transactions online, but it is a more advanced type of technology than most of us have in our homes. If you use antivirus and anti-malware protection, that can be really helpful to protect you and your data from cyber attacks. Oh, I'm clearly getting to the end of this webinar. You want to also back up your information because that's important, not just for saving you from like lost term papers or end of semester projects, but it can also help if your machine is attacked with ransomware. You might also consider using a password manager to keep track of different types of accounts, especially because we have so many of them now. And I'll talk about password managers in a minute. There are many services out there to monitor if you've ever been part of a publicized data breach, but one example is Have I Been Pwned, which we just put in the chat. So you can use that website to look up if your email addresses have been part of any data breaches in the past and have been made public. So thank you for sharing that in the chat. All right, so with password managers, in the past, we might have said that the best practice for passwords might have been to create a password that's just really hard to guess, that has both letters and numbers, and don't write it down. Now we have so many different things to remember that it's probably in your best interest to use a secure password manager. So password managers allow you to remember, ideally, one very long, complicated password or passphrase, and then it can save your login information for all the different sites and apps that you have. So if you use one password for everything and you don't use a password manager, then if one of your accounts gets compromised, the rest of them can easily get compromised too. So if you use different passwords for everything, then it lowers your risk of having all your accounts compromised, which is the benefit of using a password manager. When you are thinking about getting a password manager, it's basically one password to rule them all. You can auto-generate passwords. You want to make sure that they use legit encryption, not just like encrypted with the best encryption, right? You want to research what type of encryption that they're using. And then you might also use ones that have both mobile applications and browser plugins that can help you automatically put the logins or passwords into the sites that you're using. And some will actually allow you to share those passwords with others. So again, we're going to do identity theft and fraud on September 15th. We'll talk more about methods to secure your finances there, and I'll talk more about VPNs and malware protection and all kinds of stuff. So in summary, we just kind of want to wrap it all in a bow before we answer all your questions. FinTech is a growing field with lots of moving parts, and there are many types of financial technology, both new and old. Blockchain is a specific type of technology with lots of potential. However, it's most often recognized as the backbone of cryptocurrencies. Cryptocurrencies are mostly seen as an investment asset right now, but they can be used as digital cash or in other applications like Jake mentioned. FinTech relies on computing power to function, so it does not have it does have an impact on the environment because, most of the US electrical grid still uses dirty power methods. But people are actively looking for new ways to improve efficiency of the things like cryptocurrencies. And there are both risks and benefits of using FinTech. So learning today, bringing yourself here and kind of paying attention and being part of the chat today and asking questions, enhancing your knowledge is really helpful for you to enhance your skills, manage your own finances with this rapidly growing financial technology available to us. All right, so you can watch some previous webinars on YouTube if you want to check out what we've done before. And if you have any questions that we have missed, I think now is the time for us to answer them. If you do need to go, feel free to bounce. Again, we are recording this, so you'll have all the answers to the questions whenever we send it out, which hopefully will be within the next week. So, Jake, what questions do we need to revisit or address?
Yeah, I tried to post some in chat. So let me kind of go back through these. G Young asked about taxes on cryptocurrencies. And what I would say is that cryptocurrencies are being taxed as like capital gains tax. So similar to like if you are investing in stocks and bonds, and then you cash out that investment and realize a gain on that, make a profit off of that, you're going to be taxed on that gain. Cryptocurrencies are taxed in the same way for the most part. But whenever you're doing your taxes, if you work with a tax advisor or you do them yourself through like a Robo account, or even if you do them yourself on paper, just make sure to do your research about, how your gains in cryptocurrency sales are taxed before you ultimately go to file. I believe that we addressed this in chat a little bit too, but somebody asked about cryptocurrencies and their history of being used for illicit activities. That is true. Certain cryptocurrencies, especially like Bitcoin, kind of had this track record of being used for maybe like illicit purchases. There was an old website that has since been shut down by government authorities called the Silk Road, where people could buy and sell a number of illicit things. Things like that are becoming less and less common as cryptocurrencies are gaining more and more notoriety. And there's a lot of cryptocurrencies out there or blockchain applications that are very transparent and can track all these transactions and are actually used for like security purposes rather than illicit things. So there's lots of things. I don't want people to think like cryptocurrency is used for bad things. There's lots of things that cryptocurrency can be used for, but I think they had, based on their early uses, gained some bad rap. But I would say that that's kind of becoming less and less as they're becoming more notable. I see a couple more more questions in chat. What is the best cryptocurrency ETF or investment vehicles right now? So we're not financial advisors. I can't make any recommendations to you on what to invest in. But I would just recommend you to do your research and make sure that if you do decide to invest in cryptocurrencies, make sure it's with money that you have to invest with. We said this on our podcast that I hope you all go listen to, but it's probably, if you don't currently invest in the stock market, cryptocurrencies may not be the best thing to jump into without a lot of knowledge for investing. But I don't want to discourage anybody from that. But there are risks associated with investing in cryptocurrency. So just make sure to do your research.
I agree with Jay.
Yeah. Jason asked, I'm curious, would NFTs technically be considered part of the realm of FinTech? Absolutely, they are. NFTs are kind of this new thing. We also talk about this on the podcast as well. But since they can be seen as financial investment or something of digital value. Yeah, so NFTs, a lot of them actually operate with cryptocurrencies. But if you don't know what a NFT is, it stands for non-fungible token, meaning it's a one of one. A non-fungible token just means that it's something that can't be recreated. And what NFTs are used for primarily are to basically buy and sell digital art. Digital art is created with ones and zero on a computer. They can be recreated exactly. With physical art, no one can go repaint the Mona Lisa and have it be exactly as the original Mona Lisa. But with like a JPEG, you can just copy and paste that JPEG and it's going to be exactly like the original creator made it. But NFTs are a way to authenticate the originality of like a digital piece of art. It could be a GIF, it could be a video, it could be a picture online, but NFTs are used to authenticate that originality and determine ownership of an original piece. That's kind of how NFTs are being using.
Someone actually sold one of their tweets as an NFT. It was a viral tweet several years ago that they recently, with the development of NFTs, sold it as an NFT. So it's not just limited to like JPEGs or GIFs or memes. It could be a post on a social media site, for instance, which is very interesting.
It's a great point, Andrea. Yeah, that's a great point. You really can use NFTs for anything, but it's kind of to determine that authentication of ownership of like a digital piece of something.
All right, so we had a lot of really great questions. We'll comb through this to see if we missed anything big. The recording will also be made available hopefully by next week, maybe earlier if if the YouTube upload cooperates with me today. But if you think of any questions later, you can also email studentmoney@uillinois.edu, and we can definitely try to get an answer to your question. In the case of what types of blockchains or cryptocurrencies do you suggest I invest in, we will defer to you speaking to a financial planner. We are not allowed to provide any investment advice, just like Jake is not. So thank you.
And Andrea, right before, sorry, somebody else, Karen asked if we could provide a little information about the podcast. So I just wanted to let her know where people can find that before we go. But the podcast is called Making Sense of Money. It's hosted by myself, Andrea Pellegrini, and our other colleague, Nikki Jane Colasanks, who also works with me at IDFPR. And it's a financial education podcast. It's available on Apple Podcasts and Google Play, as well as SoundCloud. And we posted the link in chat, so just encourage you guys to check that out.
Thank you again. Have a great afternoon, and we'll make sure to send this recording out as soon as it's available.
Thanks, everyone.